Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now in the US, President Trump completes his first 100 days in office, and what 100 days it's been. Trump clearly lost no time in progressing his trade tariff policy agenda, but this, as we now know all too well, has come with its own challenges, including hurting his own domestic approval rating. Now, the question for a lot of us, including market investors today, is what are the next 100 days likely to look like? Is this likely to be more of the same, or could we see the emergence of more market-supportive parts of Trump's agenda? To discuss this, today I'm very happy to be joined by Audrey, who heads the asset allocation team at the CIO office. So welcome, Audrey. Thanks for joining us today. 100 days into Trump's term, but from your point of view, what are you expecting from Trump over the next 100 days?
Well, thanks, Manpreet. So, President Trump, after upsetting the world with a trade shock in his first 100 days in office, is likely to focus now, going forward, on trade deals in the next 100 days, perhaps. And we've also seen risk assets rebounding since he paused reciprocal tariffs against major trade partners earlier in April, and also this week, giving US automakers a 2-year tariff reprieve on imported parts. And clearly, the falling approval rating as well as signs of a growth slowdown are likely drivers of his softening stance on trade. And this week, we've also seen data showing US consumer confidence and job opening rate both slumped to the lowest levels since the COVID pandemic. So President Trump is likely to be quite mindful that his approval rating don't fall further, and that the growth slowdown that we see today don't eventually lead to a deep recession. And despite the weakening data, the Fed is likely to hold its policy rate next week due to near-term inflation risk. We would use the latest equity market rebound to actually hedge against potential downside risk as global growth slows. So investors who are overly exposed to US risk assets can consider, taking advantage of the latest US equity market rebound to partially switch into the likes of European as well as Asian equities. Developed market government bonds in terms of is a potential hedge against downside risks to growth, and they are likely to outperform equities if the current soft business and consumer confidence lead to weaker growth as well as higher unemployment. Therefore, any rebound in the US 10-year government bond yield towards the higher end of our 4 to 4.5% range would offer an attractive entry for high quality bonds. Another potential hedge is gold, and in terms of gold, we would gladly add to gold as it falls towards the US 3,000 to 3,250 per ounce range.
Thanks, Audrey. I think those are some really interesting levels across markets that investors should pay attention to in the coming weeks. But just shifting gears a bit to the other event we shouldn't lose sight of. We've got the Q1 earnings season in the US. How's that fared so far amid the tariff uncertainty?
So the Q1 earnings has been quite strong so far, and we've got about 65% of the S&P 500 index are reporting. And about 75% of the companies which have reported actually beat consensus expectations, with Q1 earnings now expecting to grow by about 12.9% year on year, which was revised up from the 8% prior to the start of the earnings season. However, what's more important is perhaps earnings growth guidance, and we have in fact seen guidance for the rest of the year soften. So 2025 full year earnings are now expected to grow by just under 9% compared to 10.5% on the 1st of April. And similarly, we have also seen 2026 earnings growth expectation being trimmed back to 13.7% from about 14.5% previously. And some companies even withdrew giving financial guidance entirely due to the macro uncertainty. So overall, if we look at US equities, investors' positioning actually remains pretty low, despite the recovery that we have seen from April sell-off lows. And this, to us, points to potential further upside for the S&P 500 in the short term, towards the 5,770 to about 5,820 resistance level. And with trade negotiations still ongoing, we would use any of such rebound towards this range to actually trim exposure to US equities and rebalance towards Asia as well as European equities.
What about China's Q1 earnings season? Any thoughts there?
So the overall consensus expectation for China earnings growth has been quite volatile. Currently expected at 8.7%, which was down slightly from about 9% at the end of March. And this contrasts to the heavier downside revisions that we have seen in developed market equities. And ahead of the Golden Week holiday, we have actually noticed that domestic tourism has been particularly resilient, with Q1 recording about 1.8 billion domestic trips, which is about over a 26% year-on-year increase. So we do expect the upcoming Golden Week holiday to support consumer spending, with travel volumes likely to hit a 3-year high. Hence, we remain overweight on China equity within Asia ex Japan.
Thanks, Audrey. Now, moving to bond markets, in recent weeks we did turn overweight on high quality government bonds. Given where yields are today, would you advocate investors add at current yield levels or potentially wait for a rebound higher?
Past couple of months, the US 10-year government bond yield has traded around the 4 to 4.5% range. And we have previously advocated adding to high quality US dollar bonds when yields rebound towards the higher end of this range and above our, say, original 4 to 4.25 forecast. So over the past week, for example, we have seen the 10-year US government bond yield moving lower, and now it's within our 12 months target range of about 4 to 4.25% and testing near-term support at around 4.15%. So assuming no resurgence of inflation worry, it is likely that the 10-year government bond yield will retest the 4% level in the very short term. So at this level though, we are quite cautious about increasing exposure significantly. Having said that, in the near term, yields remain vulnerable to upside pressure given that trade negotiation is still ongoing and unresolved, and therefore the risk of any so-called new technical stress in the bond markets, as well as the risk of any resurgence in inflation pressure is still present actually. So against this context, we believe that it is likely that the 2-year and the 10-year US government bond yield to rebound back towards the 3.95% and 4.25% respectively, where we would view it as a more attractive levels to be adding exposure. So longer term, over a 12 months perspective, we remain overweight on developed markets, investment grade bond, government bonds, and target an average maturity profile of around 5 to 7 years.
And finally, in FX markets, Canada recently had an election. So, what's your view on the Canadian dollar after that election outcome?
So Canada's Liberal Party has secured a fourth consecutive mandate in Canada, staging quite an unexpected comeback. So the party is now projected to form a minority government, likely with Carney as prime minister. However, the Liberals will need the support of other parties to form a government and pass legislation. This likely implies a shift towards a potentially looser fiscal policy than previously expected, though overall trade tensions with the US, does introduce uncertainty over its pace. So we would refrain from extrapolating the Canadian dollars, around 4% appreciation against the US dollar year to date. Trade disruption as well as policy uncertainty do pose downside risk to the economy and are likely to lead the Bank of Canada to consider further rate cuts. In the meantime, capped oil prices will continue to act as an additional headwind for the Canadian dollar. And then if you look at the US, soft consumer confidence as well as manufacturing data, together with still unresolved trade negotiation, suggest that market sentiment is likely going to remain in a wait and see mode for now. So for the US dollar index, which is DXY, we do believe that this backdrop implies a near-term consolidation around the 99 level, and we expect this to result in US dollar CAC to be trading within a range of around 1.36 to 1.40 in the coming weeks.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.